It is Sunday, December 14, 2025, which means the markets are currently closed, but the closing action from Friday, December 12th left Rivian Automotive sitting at exactly 18.42 USD, up a staggering 1.99 USD or 12.11% on the day. That double-digit surge didn't just happen in a vacuum. It was the final verdict of a week that many analysts expected would break the company, yet instead it cemented Rivian's position as the only true heir apparent to the EV throne outside of the legacy giants. When you look at a move of nearly 13% heading into a weekend, especially after the highly anticipated Autonomy and AI Day that occurred just last Thursday, the expectation was a classic buy the rumor, sell the news event. The street anticipated RJ Scaringe would get on stage, promise a few software updates, delay the R2 timeline, and leave investors with nothing but hope and a cash burn rate that looked terrifying. That was the narrative expectation. The reality, however, was a complete dismantling of the bear case. Rivian didn't just show a car, they revealed a fully integrated custom silicon ecosystem backed by Volkswagen's billions that effectively decouples them from the dependency on third-party compute suppliers. The market is not reacting to a car launch, it is reacting to Rivian transitioning from a hardware assembler to a software licenser. The expectation was survival. The reality is dominance. The volume we saw on Friday confirms this wasn't just retail traders chasing a meme. While there was certainly heavy activity on apps like Robinhood stock trading platforms, where Rivian has consistently been a top 10 holding for millennials, the real story was the block orders coming through institutional pipes. If you track the order flow on Interactive Brokers trading desks or look at the dark pool data, you see massive accumulation at the $17 level pushing right through resistance. This indicates that the smart money, the funds managing pensions and high net worth accounts via Fidelity Wealth Management and similar heavyweights, has stopped viewing Rivian as a speculative bankruptcy risk and started pricing it as a growth staple. It is a massive shift in psychology. For the last 2 years, every time Rivian popped, it was sold into oblivion. This time, the bid held. The short sellers who've been camped out in this stock since 2022 are now facing a liquidity crisis of their own, which likely fueled that final hour squeeze on Friday. When you have a stock with high short interest suddenly deliver a gross margin positive quarter followed by a technology roadmap that actually works, you get a violent repricing. Let's talk about what actually triggered this, because if you're just looking at the headline numbers, you're missing the structural change in the business. The Autonomy and AI Day on December 11th was the catalyst. The market was terrified of the Osborne effect. The idea of announcing the R2 would kill sales of the R1. Instead, Rivian threaded the needle perfectly. They confirmed that the R2, launching in early 2026, will debut without LiDAR to keep costs down, targeting that sweet spot of $45,000, while the advanced Gen 3 autonomy stack with LiDAR will come later. Why is this bullish? Because it shows financial discipline over engineering vanity. A younger Rivian would have delayed the car to get the tech perfect. The mature Rivian, the one we see now at $18.42, is prioritizing volume and cash flow. They're launching the car that people can afford when they promised it and upgrading the tech later. This is exactly what the analysts at Schwab Intelligent Portfolios and other algorithmic desks want to see. Execution. The reveal of the Rivian Unified Intelligence Network was the cherry on top. This isn't just about driving the car, it's about a data foundation that ties diagnostics, service, and user experience into a single AI loop. This is the Apple approach to cars, creating a walled garden that is sticky and high margin. You have to contextualize this against the broader market. We're in a unique environment in late 2025 where interest rates have finally stabilized, which lowers the cost of capital for capital-intensive businesses. For a long time, high rates were the boot on Rivian's neck. Now, with the Fed easing off, companies like Rivian that need to build massive factories, like the restarted Georgia plant, can actually finance that growth without diluting shareholders to death. If you use SoFi Investing or check the SoFi Active Investing dashboard, you likely saw the sector heat map turn green for EVs for the first time in months. This isn't just Rivian rising, it is a sector rotation, where capital is flowing out of safe, slow-growth staples and back into validated tech hardware. However, Rivian is outperforming Tesla stock on a relative basis this week because Rivian is in the acceleration phase of its S-curve, whereas Tesla is in the saturation phase. Investors looking for that 2020-style growth are realizing Tesla stock is too big to double overnight, but Rivian Automotive at an 18 handle still has massive headroom if they simply execute on the order book. The Volkswagen partnership is the other pillar holding up this price action. We've known about the joint venture for a while, but the RV Tech entity is now fully operational, with teams co-located in Palo Alto. This is not just a press release. This is Volkswagen, one of the largest automakers in history, essentially admitting they can't build software and paying Rivian billions to do it for them. The $5.8 billion total deal size is a fortress balance sheet. It bridges the gap to the R2 launch and the Georgia plant production in 2028. Before this deal, every analysis of Rivian ended with, "But will they run out of cash?" Now, that question is off the table. The cash runway extends well past the launch of their mass-market vehicles. For individual investors managing their own individual brokerage accounts, this removes the single biggest risk factor. You are no longer betting on solvency, you are betting on demand, and demand has never been Rivian's problem. The R1T and R1S are still widely considered the best EVs on the road. Period. The issue was always, can they build them profitably? The Q3 2025 earnings report showing a $24 million gross profit was the proof of concept. They are making money on the units they sell, or at least the software services are covering the automotive losses. That is the inflection point NVIDIA stock hit years ago before its explosive run, when the platform becomes more valuable than the hardware. Speaking of the platform, the comparisons to Apple stock are becoming more legitimate. Rivian is building a lifestyle brand, not just a car company. The Halloween mode, the adventurous branding, the charging outposts that feel like national park lodges, it all builds a moat that is intangible but powerful. When you look at Fidelity investment research reports, they often cite brand equity as an intangible asset. Rivian's brand equity is off the charts. People love these trucks. They identify with them. This is why the Robinhood app activity is so high. Retail investors are buying what they see on the road and what they aspire to own. It creates a floor for the stock price because the shareholders are also the customers. Contrast this to other EV startups that have faded into obscurity because nobody cared about the product. Rivian has created a tribe. However, we must remain objective. The road to $18.42 has been paved with crushed dreams and massive volatility. The reality check here is that Rivian is still scaling. The Normal, Illinois plant is running well, but the Georgia plant is a massive undertaking that will consume billions. Construction is restarting in 2026, and they don't expect production there until 2028. That is a long time to wait for the next leg of volume growth. The R2 is the bridge, but if there are supply chain snags or if the custom silicon has yield issues, the stock could easily retest the single digits. Investors using Interactive Brokers stock trading tools to hedge their positions are likely buying puts as insurance even while being long the stock. It's a prudent move. The market is pricing in perfection for the R2 launch. Any deviation from that timeline will be punished severely. Furthermore, while the SoFi robo-advisor algorithms might be allocating to Rivian based on momentum, the fundamental valuation is still rich compared to legacy auto. You are paying for 2030 earnings in 2025. Let's pause for a second and take a pulse of the room. I want to know where you stand on this valuation. Comment below how many shares of Rivian you currently hold, or if you are waiting for a pullback to enter. Are you buying the breakout, or do you think this is a bull trap before the R2 expenses hit the balance sheet? Getting back to the analysis, we have to look at the competitive landscape. Tesla stock is the elephant in the room, but NVIDIA stock is the hidden competitor. As cars become computers, the compute layer becomes the battlefield. Rivian's decision to build its own autonomy compute module, rather than buying off the shelf from NVIDIA or Mobileye, is a high-risk, high-reward bet. If it works, they control their destiny and margins. If it fails, they are left with inferior tech. The Autonomy Day presentation suggests it's working, with universal hands-free rolling out to Gen 2 vehicles. This feature allows hands-free driving on 3.5 million miles of road. This puts them effectively at parity with Super Cruise and Autopilot for highway driving. For a company a fraction of the size of GM or Tesla, that is a monumental engineering achievement. It validates the software-defined vehicle buzzword that everyone uses, but few execute. The activity on investing sites and forums this weekend is focused heavily on the RV tech software stack potentially being licensed to other automakers beyond Volkswagen. If Rivian becomes the Android of EVs, providing the OS for multiple manufacturers, the total addressable market explodes. This is the hidden upside that isn't fully priced in yet. Volkswagen is the first client, but they likely won't be the last.